Hello everyone, today is the 15th of October 2025. Why a Jefferies bailout is only a matter of time is today just Stadio Daily. Before we begin, if you want to support my channel, don't forget to like the video, subscribe, and turn on the notification not to miss my future update. All right, let's begin. I admit I never paid too much attention to Jefferies, since in the grand scheme of things, this bank is a relatively marginal player in the global financial system. I was fully aware, though, that their strategy to climb Wall Street league tables mostly relied on dealing with assets and companies many banks wouldn't touch with a 10-foot pole, usually because of too many compliance red flags. The recent and sudden bust of First Brands Group brought Jefferies and its dealings under the spotlight. So, out of curiosity, I started to look into their financials to gauge the health of this investment bank. Frankly speaking, considering there are many analysts out there who did this before me, I wonder how no one noticed the overwhelming number of red flags sitting in plain sight on Jefferies' SEC filings. Let's start by taking a look at Jefferies' assets and liabilities. As you can see from the table here, net repo financing, securities sold or purchased under repo agreement, is roughly $4 billion negative. Receivables minus payables is roughly $1.5 billion negative. Short-term borrowings jumped to $1.2 billion, or 3 times in the last 9 months. Other secured financing is roughly $2.7 billion. Accrued expenses and other liabilities are roughly $3.1 billion. The total is roughly $12.5 billion of short-term financing. How much cash and cash equivalents does Jefferies have on its books? Roughly $11.5 billion. Putting it all together, without all these forms of very short-dated and by definition unreliable financing, Jefferies' cash position would be roughly $1 billion negative. If this isn't a massive red flag, I don't know what it is. Another interesting thing about Jefferies' numbers is financial instruments sold, not yet purchased, at fair value. What's this about? These are short positions Jefferies has for a total of roughly $12.3 billion that are effectively another form of very unstable short-term financing. Second massive red flag here. Adding this to the previous calculation, the total is a theoretical negative cash position of roughly $13.3 billion. Considering roughly $4.4 billion of shorts are in equity, and that stocks are trading at all-time highs, how large are the losses Jefferies is hiding here? They forgot to share details about this. At this point, someone might argue that Jefferies owns roughly $26 billion of financial instruments. However, digging deeper, it doesn't take long to find out that roughly $20.5 billion of these have already been pledged as collateral that isn't part of repo transactions. Collateral against what exactly? I smell big losses on derivative positions and guarantees here. The last interesting thing in Jefferies' balance sheet assets before we move forward is roughly $1.5 billion of loans and investments to related parties. What are these exactly? This is capital and liquidity that Jefferies injected into its off-the-books VIE vehicles used to repackage and sell toxic assets. Let's take a closer look at this. As you can see in the table here, VIE vehicles sponsored by Jefferies piled up roughly $49 billion of CLOs, ABS, private equity, and other investment vehicles. All these assets are not consolidated in Jefferies' financial. In order to sell these assets and pocket large commissions in the process, which make up a good chunk of Jefferies' revenues, the bank clearly extended guarantees. considering the bank itself declares a maximum exposure to loss of roughly $10.4 billion. Here is how Jefferies explains their maximum exposure to loss risk. Our maximum exposure to loss often differs from the carrying value of the variable interests. The maximum exposure to loss is dependent on the nature of our variable interests in the VIEs and is limited to the notional amounts of certain loan and equity commitments and guarantees. Our maximum exposure to loss does not include the offsetting benefit of any financial instrument that may be utilized to hedge the risk associated with our variable interests and is not reduced by the amount of collateral held as part of a transaction with a VIE. How much is Jefferies' total shareholder equity? Roughly $10.5 billion. Clearly, if we consider this direct exposure to losses and the hidden losses on equity short position without considering anything else not to make things look even worse, Jefferies does stand a high risk of quickly becoming insolvent. It should not come as a surprise that Jefferies executives have already started to control the damage, stating the bank is solid. Kind of reminds me of Credit Suisse a few years ago. However, clients have seen enough and are already flooding Jefferies with redemption requests to get their money back as soon as possible. I wonder if, after avoiding doing due diligence, they figured out how precarious Jefferies' liquidity and capital positions are. Clearly, it is only a matter of time before things turn from bad to worse for Jefferies. My bet is we will see a Fed-orchestrated bailout where Wells Fargo takes over its operation and avoids a dangerous contagion to other institutions that have been involved in similar repackaging and distribution of toxic assets over the years. Why Wells Fargo? Because it's the only bank with a quote-unquote free capital buffer that can be deployed against Jefferies' books after the bank has been released from the penalty box it stood in for several years due to the mortgage scandal it was previously involved in. Don't worry, though, Jefferies isn't a systemic bank, and even if steep losses from its activities can surface all around the global financial system, the total amount will still be manageable thanks to the endless amount of liquidity central banks keep injecting into the system. However, this situation is a big warning sign that problems are set to increase in the future, especially when the Fed itself helped banks to hide them in the last round of stress tests. As I flagged in my report, 2025 Fed stress test reveals how today's Fed is complicit in hiding banks' problems. Thanks a lot for listening to my podcast again today, for supporting me on X, Instagram, and for reading my research on justdario.com. I wish everyone a nice day.